Hi, this is Brent with Trade Therapy. Welcome back to the Trading Couch. Last week, our Clarity Spotlight was on PayPal. That means we're going to take a look at the entire financial sector, starting with XLF. XLF is really sets the benchmark for the sector. And what we found was the financial sector is pressing up against this long-term resistance line right here. It's running into the 1272 Fibonacci extension from the Great Financial Crisis pullbacks. If we're running Fibonacci on the Great Financial Crisis, our 1 will be the top, our 0 will be the bottom. And this extension level up here gives us the areas where historically institutions have been the most likely to take profits. So we do see it bumping up into that. If we zoom in a little closer, but we can run a local fib from the 2022 drop from the high there to the low there. And we see that a 1618 extension also is bumping into that same area that we saw in the longer term chart. That is a Fibonacci cluster. That means that the likelihood of Wall Street taking profit at this level is even higher. And so it's not surprising for us to see a 1, 2, 3, 4, 5 Elliott wave impulsive structure here running up against resistance and setting up and looking like it could possibly drop back in and do a back test into this inefficient range right here. You see these long candles. It's not much support. So typically what will happen is Wall Street will take profit and then back test into these areas and provide some support by taking out the inefficiency. And we did note the bearish divergence or negative divergence that had developed in the financial sector overall. From there, we took a closer look into the Fintech sector, which is the FINX ETF. This is the all-time weekly that we last covered in April. And at the time, we had mentioned that the Fintech sector was backtesting this pivot where there was resistance, and that finally broke out, and they were backtesting it, and some profit being taken here from this impulsive move right there. We were trying to figure out back in April if it was going to come down to this point of control from its volume profile that would also coincide with this lower pivot right there. If we jump over to current chart, we can see the all-time weekly again with Fintech. It did come down and back test this level, undercutting this previous low right here. Very common, one of Wall Street's favorite tricks. When they take profit, they want to take out all of the within range structural lows before they move on with their uptrend plans. And that's what we've seen develop here. We do see negative divergence here. So we do see consistencies in the financial sector, in the fintech sector. We then looked into IPAY, which is the digital payments ETF. This is a weekly chart. We see a classic institutional business cycle here, profit taking, distribution, redistribution here, and then reaccumulation with that same type of a setup where they set a pivot in their accumulation range, providing resistance, not allowing price to break out while they're buying it up until they're ready to push it out after they take a real deep undercut of the entire range. That is a Wyckoff spring. This is jumping across the creek. This is Wall Street rapidly moving price up and out of the range and then back testing it. So anybody that chased into it, they want to take them out. We now see a reaccumulation range right here. They are taking profits from this run. We do see, again, possibility of a back test into this pocket, this liquidity pocket right here. There's no support, so there's nothing stopping it here. It is August. It is volatility season. So from a sector level with XLF, looking at the entire financial sector, the fintech sector, and then now digital payments all having the same setup, an ABC larger reaccumulation structure with a shorter time frame ABC setup. We then took a look at peers. The first peer we looked at was Block. If we look at XYZ, we see a similar setup here. Again, here's the accumulation or institutional buying range right here. They keep a cap on it. They like to rush it up to the top to lure in retail traders, only then to come back down and reverse it back down. This is luring retail in and then taking them out, luring it in, taking them out over and over again until finally breaking out, thinking everyone jumping in, thinking that it's going to finally get out of this range. And then they do a deep back test here. This is one of Wall Street's favorite tricks. You can see that they've also broken out one of their favorite tactical strategies on an even smaller time frame. Last comment on XYZ. A higher time frame daily chart here is the beauty of this accumulation range right here, combining with the reaccumulation structure. Whenever you're studying the institutional business cycle, after something distributes, after they take profit, always look for that redistribution. So there's going to be a middle tier where they take profit, they take a short position, they then take profit on that short position, lure everybody in thinking they bought the dip, only to turn around and bring it back down into the range where they're interested in accumulating. And that will typically align with the reaccumulation range from the previous run. So all of those things are in place. All of those things are signals, are tells on where Wall Street and the institutional business cycle is at this moment within block. This gap up and then fade on earnings is that favorite tactical strategy that Wall Street has when they're at the end of these impulsive moves right here. That's why we're seeing so many of these gap up and fades during this earnings season, because we have come out of a big run out of the April lows. There's a lot of profits on the table that Wall Street needs to take. And this is how they like to do it. They can set this up with a gap up, lure a bunch of buyers in, and then sell into them, and then set up an ABC correction back down to test probably these moving averages right here, possibly down to the 238 at 62.42 as the next level back. That's what we saw in XYZ. If we look over to Affirm, Affirm was our the last peer that we looked at before we got into PayPal. Affirm is a much more mature looking chart comparatively to XYZ. You can see the accumulation range. You see that resistance. It broke out, comes back and back tests. It's now support. It comes out, back tests that. It's a support again. And so we're seeing a series of higher highs. Affirm is in an uptrend. The first breakout of an accumulation range, or the institutional buying range right here, is called a minor sign of strength. As it backs up and tests, if it comes out, it sets a new higher high. That is the major sign of strength. An uptrend, by definition, is a series of signs of strength that then backtest moving averages. So this type of a structure is what we would expect to continue moving forward. We do believe that Affirm is also set up to do a back test right here, to take out some of the liquidity, to take out last little bit of supply here before we believe we'll then move out into its new uptrend. We don't have any positions in any of the charts we've covered so far, but we are long PayPal. PayPal was our feature last week. And if we look at PayPal, this is what it looked like the last time we covered in April. That was during the tariff scare, and we had mentioned that this could be the end of this pullback here because it's hitting the structural low right there. We know that this is a very mature base. This is an institutional buying range. We did not believe that we were going to see PayPal continue breaking down here. We jump over to current weekly chart. We see that that is indeed where it stopped. It did come down underneath the structural low, which is what we were looking for to complete a series of fake outs. We're going to break out. Oh, no, we're not. We're going to break down. Oh, no, we're not. And so this is what Wall Street does. They're in the business of tricking retail traders. So this is how they accumulate their positions. We do believe again, that PayPal is also set up for an ABC backtest. So we saw it at the highest level in the financial sector. We saw it in Fintech. We saw it in digital payments. We saw it in XYZ and Affirm. It's a very strong signal. That's why we do top-down analysis. So we know what to look for when we get into our featured analysis. And if we drill down into a smaller time frame and take a look at trading levels and where we think all of this will end up, we do believe that PayPal does have a bright future moving forward. Once we get through this last little back test right here, we are long PayPal. We are looking for this entire accumulation structure to resolve to the upside moving forward as monetary policy begins to ease. PayPal falls squarely in that sector of the market that has been sensitive to interest rates and has been held down as interest rates have been held high. If you like these setups, if you like this level of detail, if you're tired of chasing headlines and you want the full breakdowns, you should subscribe to Clarity. We provide this institutional level analysis every week, including all of the charts, all of the trade levels that we're considering, all of the scenarios, as well as full breakdown videos. This is just a highlight video. You should join us. There's going to be a coupon up in a moment. It's all the time we got this week. We'll see you next week.